when do we recommend one or the other? With whole life in general, if somebody has a set amount of money that they want to move into a policy, so an emergency fund, a capital expense account, so like if they have rental real estate, and you generally need to save a certain amount of your money each month so that it's there in case you need to repair the roof, buy a new water heater, fix the driveway, paint the house, things like that. You'll have a capital expense account. Money that you aren't going to touch, it just needs to sit somewhere until it gets needed. Well, in general, you don't want that money sitting in a checking or savings account, not doing anything for you. Okay. Same thing with emergency funds. You don't need your whole emergency fund sitting in a checking or savings account ready all at once. In general, if you've got a 3 to 6 month emergency fund, you might only need access to a very small portion of that in an emergency right away. Whereas, you know, we have 3 to 6 months of expenses because we expect for that to last 3 to 6 months. If we have a longer term emergency, like we lose a job or something. So much better to keep the bulk of that inside of a whole life policy, something that gets us guaranteed growth, because we want to make sure that the money that we're taking from the emergency fund or the capital expense account, it always has to be there. Okay. In an IUL, it's not necessarily going to be there. You could theoretically get 0% returns multiple years in a row in an IUL, and you still have to pay the cost of insurance. Now, with the designs that we do, that cost is minimal. So the risk of this happening is very low. The risk of you having less money than you put into it is very low. Okay. After a few years, right? But in whole life, we have guarantees. We know the money is going to be there, but this is a set amount that we want to move in. And if we come back down to the policy can be fully funded, this is why I like a whole life for that, because we can transfer that money over the course of 7 years, transfer it into a whole life policy, and we can turn it off. If they have no desire to keep paying ongoing premiums because they just transferred that set amount of money that they were trying to move into there, and they don't want to do any more than that, you can do a fully paid up policy at that point. So these are ideal in that scenario. The whole life is. Also, if they want to do a very large portion of their income, I talked about that earlier, same thing applies. You know, me personally, I would feel more comfortable doing that in a whole life with some guaranteed growth. The IUL, we like to treat that one like a retirement account. So if somebody's going to fund it like a retirement account, they're funding it at a small amount regularly up until retirement. Not necessarily a small amount, could be a large dollar amount, depends on what that means to you, but generally at a retirement account level, right? So like $6,000 a year, like a IRA or Roth IRA, or $19,000 a year, like you might put into a 401k, something like that. Those are really good to do in an IUL. If you could do that every year until retirement, that turns into some really good income, and it's safe, and they can utilize it throughout their life as well. They don't have to risk withdrawing it from a retirement account and paying penalties for having to access it early. A lot of benefits in that regard. But you also get that greater growth potential from the IUL. So the last thing would be, what is their comfort level for risk? I get a lot of people that they have no interest in participating in the stock market, and that's totally fine. Whole life insurance would be a great choice in that regard. Other people, they could go either way, and they may be more attracted to the growth opportunity in the IUL as opposed to just the dividend options in the whole life. So really what it boils down to is you're going to talk to your clients, and you're going to use the information that they give you about their overall retirement efforts, their portfolio, and use that to determine which product you think might work out best. Both of these I view as a good supplement to a retirement portfolio, to an overall portfolio, I should say, not just a retirement one, but an overall portfolio. I view the IUL on whole life as a conservative part of that, because we know we have downside protection. Which one they choose is going to be how much upside potential do they want to get for those same dollars. And a lot of people may decide to blend the two. You know, you might get some whole life policies and IUL policies from the same client, and even among the same family. So hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.